Welcome, everybody. My name is Clyde. I'm the Chief Innovation Officer at BrightRock, and I'm going to be talking about some of the problems in the group risk industry in terms of insurance and what needs match change can bring to remedy some of those problems. So to start off today's session, we're going to use a bit of a case study, and that case study is an example of a company, 200-person company, and we're going to be dealing with John, who is the finance head at that business. And John has been tasked with getting some insurance cover for the scheme, and he wants to get some group cover, and he's looking at options in the market. Now, we know, and you'll know, that the workplace is changing, and employees are becoming more and more focused and asking more and more about what their employer can do for them. They're worried about their safety, and they expect their employers to play a bigger and bigger role in protecting them. In fact, this survey, redesigning the employee experience by MetLife, shows that 80% of employers are planning to increase the range and or level of investment in employee benefits after COVID-19. It's really put the spotlight on how we protect our people and what employers do to protect their employees. If you think about what someone like John is looking at and what today's employees want from their benefits, they certainly want comprehensiveness. They want to know that they've got the best cover. They want choice. They want tailored solutions tailored to their personal preferences. They want access to expertise and advice. And they want flexibility and clarity in terms of what it is that they're buying. And that's certainly top of the requirements from John making this decision. He wants a group risk product that really adds value, not only to his business, but also adds value in his employees' lives, and that covers their individual needs. Now, when we speak to John and we ask him what he's worried about, what he wants to protect, of course, the biggest concern for his employees is their take-home income. That's anyone's single biggest asset, and group risk cover gives us a mechanism to cover and insure those remaining paychecks really well. So if we have a look at John, he takes himself as an example. He's 40 and he says, my single biggest asset is my ability to work for my remaining working life. I have 25 years left. In other words, today as a 40-year-old, I have 25 years of paychecks to replace. When I get to 60, however, I'll have only 5 years of paychecks to protect. In other words, 60 paychecks remaining. So with every year that passes, there's a year less of paychecks that John has to worry about and has to insure and protect. So his need, his financial exposure as a 40-year-old is the highest it's ever going to be today to protect that biggest asset that he has, his remaining salaries, his remaining paychecks. And as he approaches retirement age, the number of paychecks that he has to protect reduces, and so does his exposure and his concern. Now, he's just one of the 200 people on the spectrum of this employer's working group across age. Some of them a little younger than he is, some of them a little older than he is, and he's pretty much in the middle. But what we know is in exactly the same way that John's needs change over time, each one of these employees has got a different set of circumstances and a different set of financial needs. And each one of them is a different distance away from their retirement age. Those of them who are younger, with longer to go till retirement, have got more paychecks to protect, more salaries that they are worried about, more salaries that they'll lose if they were to become disabled, or if they were to pass away, more salaries that their family would lose out on. On the other side of the age spectrum, there are some older colleagues that John has, and they have the lowest exposure. They have got fewer paychecks to protect, fewer salaries to go until retirement. And so their exposure is a little bit lower. So as you can see, we have a bit of a curve that follows the same theory as John's individual curve. As employees get older, so the number of paychecks they have to protect for each one of those employees reduces. And as they get younger, their exposure increases quite a bit. That's nothing new, that's no surprise. But what that does illustrate is one of the big problems and shortcomings in the way that insurance has historically been priced. And that's one of the topics I want to cover today. I want to deep dive into some of the shortcomings with traditional group life insurance and the way that as an industry and as a market, we've thought about protecting John's employees and hopefully talk about some different ways and some different solutions to overcome those problems. Now, the first problem, in my mind at least, is inefficiency in the way that historically we as product providers have structured that cover. If we take this example for starters, John's 200 employees in this business, the way we would traditionally resolve their group risk problem is to sell them a multiple of salary approach. In other words, if they could afford it, we would sell them 3 times annual salary as their insurance cover. Now, if you overlay that 3 times salary benefit with the exposure that we spoke about earlier, you'll get a picture sort of like this. And if you think about it, the person who's 62 years old, 3 years of salary would take them to 65. So they'll be as insured as they would have been if nothing happened. In other words, we'll replace 100% of their remaining paychecks, 3 years worth of paychecks. So a 62-year-old, 3 times salary is actually perfect, and they're insured 100%. But someone younger with, let's say, someone at 25 years to go, 25 years old, has got 30 years to go till retirement. So 3 times salary is really only going to cover 10% of their remaining paychecks, their need and their biggest worry in terms of that biggest financial asset that they have. So as an employee benefit or as a group benefit, the 3 times salary has got a couple of problems. The first one is that it's quite inequitable. Older people closer to retirement are covering a much bigger proportion of their need, of their share of cover that they need to protect them and to replace those remaining paychecks, whereas younger employees get a much smaller proportion of their remaining salaries or their remaining paychecks insured and protected. That's exacerbated by the way that the pension savings works. And if you think about that, the younger you are, the less you've saved towards a pension or provident fund. The older you are, the more that savings has built up. So you not only have the problem of having a lower percentage of your remaining paychecks protected, you also haven't had enough time to build up a savings in the pension environment. The older clients on the right-hand side of the spectrum benefit both from having a much higher proportion of their need insured and at the same time also having that buildup in the pension available to them. So there's almost a double benefit to those clients on the right-hand side of the age spectrum, while the ones on the left are hit twice as hard. If we flip that around, in other words, if we draw that first line up and instead look at this relative to the need, if we call the need protecting 100% of my remaining paychecks, you see the same picture coming out. The younger clients protecting 10 to 15% of their remaining paychecks through 3 years worth of salaries. And as we get older, that number jumps from 60%, in fact, to in excess of 100% if you think about the people beyond the 62 years. And that results in an inequitable share of the cover. If we think about all the cover that the employee can buy, we're now splitting that out amongst the employees in quite an unfair manner. We're giving clients with a short amount of time to retirement with a big buildup in their pension funds 60, 70, 80% of their remaining paychecks covered, while as younger employees covering a far lower percentage, 10, 15%. And the result is not only an inequitable share, but quite an inefficient way to price life insurance cover. Because if we share out the insurance in that manner, the people that we're giving the most cover to are also the people who are the most expensive to insure. So the cover that the scheme can buy as a whole reduces. So that's why I'm saying one of the problems that we have in insurance today is this inefficiency, and it stems from the way that we distribute and share the cover that the scheme can buy as a group. What we're seeing that result in is a few things. The one, a race to the bottom, absolute price competitiveness and commodity-driven sales, where we just want to get the cheapest price because cover is very, very expensive. That means employers can't buy as much as they'd like to, and they reduce the amounts of cover that they can afford. And what product providers tend up doing is reducing the quality of the benefits to make them more affordable and participate in that race to the bottom. And we're seeing that in stats today. I want to share with you some statistics from the True South Gap study. This shows how much cover and how much exposure the average employee has and how much cover they're able to afford through group benefits. And I want to point you to two trends. The first one is you'll see as clients get older, they can cover more of their exposure, which aligns very much with what we were talking about earlier. If we're covering through a flat multiple of salary, that makes perfect sense. The closer they are to retirement, the further that multiple of salary will go. So that's the first trend, that sort of upward curve. If we have a look on the graph over here, the older clients covering bigger amounts of their exposure. And you can see that 12%, 7% number aligning very close to the numbers we spoke about earlier. The second trend that I want to point you towards is between 2016 and 2019, we've seen a reduction in the amount of insurance being bought by employers for their employees through group benefits. Quite a big reduction happening. So there is a tightening happening, and we know that COVID has only exacerbated that. So the real question here is there a way, number one, to get a group more cover for the same premium? Number two, is there a way to distribute that cover more equitably and cleverly in a way that benefits the majority of the employees a lot more? Can we make that premium rand go further? So can we solve that inefficiency problem? Where does it come from? The majority of the employees, we're literally talking 80 to 90%, are younger and sitting on the left-hand side of the spectrum. They've got a large exposure. They've got many years to go, many paychecks that they need to protect. They've got a lower savings buildup, and they've got a higher risk. The older clients on the right-hand side of the spectrum, they dominate the cost base, but they really are the minority in terms of the numbers. They've got the lowest exposure because they're the closest to retirement age. Their savings buildup is the highest, so they have the benefit of that, and yet they are the higher risk and cost to the group. So if we split the cover inequitably in that multiple of salary, which takes no cognizance of how long everybody has to go till retirement and how much needs everybody has, if we just split the cover out random, an open flat multiple of salary, like we showed earlier, what you end up with John's scheme is 250 million rand of cover in the traditional approach. My question to the industry and my question to you is that the best solution, and can we do a bit more? And particularly in the times that we see now and the pressure on premium, could we make that premium go further? Second problem we see is inflexibility, and this stems from a number of different points of view. The first one is there simply is no link to the advice and the need of the client. So we go with a blanket 3 times salary, but we don't really talk to how much the client needs. We don't in the way we think about group risk. It's a very commoditized sale, and it doesn't open the door to that flexible, tailored advice discussion, even after the group sale, because we haven't laid the foundation of talking to the client and saying, you actually have 30 years of salaries to protect. Three years of salaries are not going to get you there. But in the discussion with your advisor, we can close that gap. And possibly with a cleverer designed group risk product, we can close the gap even further. Buying more cover and changing your cover later is also difficult. And portability is a problem. You can't move that cover to an individual product later on. That's underpinned by uncertainty in the market. Blanket survival periods, subjective definition criteria like an occupational definition without a list of conditions you can claim for, and post-claim penalties make that even worse. We don't have to live in a world like this, though. A lot of these solutions in 2021 can be resolved. So if we look at the efficiency argument, one angle is to say, rather cover a percentage of remaining paychecks. In this example, the client's premium, John's premium, could buy 30% of everybody's remaining paychecks covered and insured. In other words, 90% of the membership base getting more cover for the same premium. The rest could choose to buy up free of medical underwriting. If you do an example like that, the scheme can spend the same amount of money and take the 250 million rand to 400 million rand of cover. The savings go even further because you can take those traditional barriers to claim and those traditional concerns that reduce certainty and remove them. So you can eliminate blanket survival periods completely. You can include a list of conditions. If you get cancer stage 4, the product pays whether or not you go back to work. Those can be transparently disclosed up front, and you can remove post-claim penalties. You recover, you reassess, it doesn't matter, you can go back to work. So the way we can assess this is There are problems in the industry, but they can be resolved. Through using the latest technology, we can give the scheme 40% more cover for the same premium, which means 90% of more members have more cover. Everyone can have access to double their cover even further, free of medical underwriting with a feature included. And that product can be the best in the market with, for example, market-leading certainty and comprehensiveness. And then finally, that group risk product can be portable and moved to an individual product when the client leaves the scheme. So significant issues at the moment where we stand, and a tough environment by every stretch of the imagination, but these are not insurmountable problems. We think if you look at a needs-matched solution, which is what BrightRock focuses on, you can really overcome these issues and provide much more value to both employers and employees. Thanks for your time.